Down payment assistance programs are a great way to achieve home ownership. However, there are pros and cons of these programs. So it's really important that you understand how they work to see if it's the right program for you to use to achieve home ownership. In today's video, I'm going to go over the pros and the cons of these programs, and I'm going to speak from experience because I have used one of them and so has my daughter and son-in-law. So stay tuned. Hey, Laura Gallen here with Mountain Prairie Living Empowered by ERA Shields, and welcome to my channel where I answer questions about the home buying and selling process. I talk about Colorado Springs, this beautiful place I get to live, and some of the processes of home buying and selling. In today's video, I'm going to discuss down payment assistance programs, and just stay tuned to the end to see if this is the right program for you, because it does work to achieve home ownership, but you need to know and understand the pros and cons of these programs. So let's get into it. First, let's talk about the pros of a down payment assistance program. Number one, it's the ability to purchase a home with a very low down payment or very little money into the transaction. Number two, access to lower interest rate loans. Now there's a pro and a con of that, but you can achieve a lower interest rate even with a lower credit score. Some of these programs, the money that you can utilize will actually also help cover closing costs. Some of the programs actually have grants also that do not have to be paid back. Now those are usually limited funds, and once they're gone during the year, they're gone. But those are ways that you can have free money in some of these programs if the area qualifies and you qualify. So there's some details to that. And of course, the biggest pro why people look to these programs is because with lower income, you may be able to qualify without having to save a whole lot for a down payment. But there are some cons to all of this. So what are some of the cons to a down payment assistance program? Now, one of the cons is you may have to be eligible for this. You might have to have an income that's below a certain level. You're definitely going to need to attend a first-time home buyer course, which is a pro because it's going to teach you some of the basics. But some people don't want to have to go through a course to achieve home ownership, and so that might be a con for you. Now, some of these programs have limited geographic areas, so only certain parts of your city may be eligible for those programs. So each one is a little bit different. Now, you must have a minimum credit score typically of about 580. Some of the lenders that lend for these programs may actually put an overlay which requires at least 620 credit score. Now, additionally, even though the interest rate is lower, depending on your credit score, that interest rate might be a little bit higher for you than what is normal in the market. So your credit score does matter even with these programs, even though they are achievable at the lower credit scores to help that first-time home buyer get in. If your credit score is extremely low, that lender may put an overlay that requires them to increase the interest rate just a bit more because you're flagged as a little bit higher credit risk. And here's where it really gets into some of the cons. These loans have restrictions on them and they have expectations on them. So I'll talk about them when I tell you the stories that I have experienced with these programs so that you fully understand how the programs operate. Let's talk about my experience with a down payment assistance program. I used CHFA, the Colorado Housing and Finance Authority, and they have a program for first-time home buyers. And a first-time home buyer, just to clarify to you, is someone who has not owned a home in the last 3 years, or someone who's never owned a home. So remember, there's a little bit of delineation there. So you might not have owned a home for several years, and you would still qualify to be a first-time home buyer in this situation. Now, I used the program. I went through the home buyers class. I had to attend it in person. This was several years back. My kids did it online, so you could do it either way nowadays, but you do need to attend the course and achieve that certificate. Now, both my daughter and myself put $1,000 down earnest money when we went to purchase the house. Before we even went house hunting, though, we had to be pre-approved for a FHA government loan, which required a 3.5% down payment. And closing costs typically are another 1.5%. So let's talk about how it worked for me. I didn't qualify for the grant. Neither did my daughter and my son-in-law. So we achieved what was called a silent second. And so the silent second went on, and that covered the down payment, the 3.5%, and it covered the closing costs. So we signed the documents. We had to be pre-approved. We had to submit all of our information just like you would for any other loan. And we had to get pre-approved, and our debt to income ratio had to meet the parameters for that. Now, in this situation, that debt to income ratio might be a little bit higher. If you'd like to know more about debt to income ratio, I did a video on that, and I'll tag it up here. But we had to qualify. So let's define what a silent second is. In my situation and my daughter's situation, they put a silent second, which meant that we borrowed a certain amount of money, and they used it for the down payment, and they used it for closing cost, and that became a second lien. It had a second place position on the property to the first trust deed, which was the FHA 3.5% down loan program. That silent second has no payment, so I don't have to add that into my principal and interest. I'm only being qualified a debt to income ratio with the first trust deed payment. The silent second sits on the home. It does not have a payment due each month. However, if I go to refinance the home in the future, that triggers that it has to be paid off. It can't not be paid off. You can't resubordinate it to a second position. They're not willing to do that. That's something that you're signing for, that you understand that if you go to refinance, you have to pay it off. If you sell it, it becomes due then also, obviously, because it's a lien on the property. So let's talk about what could be on that payment. Your home payment is typically made up of principal, interest, taxes, and insurance. PITI is what they say. So you have the principal and interest of the loan, the money that you borrowed, the taxes, because they want to escrow for the taxes. They want to make sure that every month your payment is going to include a percentage that will equate to the annual taxes, so that when they come due, the lender will pay it. And insurance, you're going to be, again, escrowing for that. That way the lender ensures that the insurance stays on the property. And so you'll have a PITI payment that you need to qualify for. But with an FHA low down payment loan, that 3.5%, the lender is going to require what's called private mortgage insurance. It's an insurance that the lender asks for because you're a higher risk, because you're putting less money into the transaction. And so that's an additional monthly fee on top of the PITI. And it can be anywhere from, depending on the home purchase price, it could be anywhere from $200 to maybe $350 additional on top of that, and you need to qualify with all of that in there. And if by chance the home you chose to purchase had a HOA fee on it, then that would also have to be added in there to check on your debt to income ratio. So you can see that this can start to add up. It's not just your principal, interest, taxes, and insurance, it's also PMI. And if you're in a home ownership or homeowners association area, it could be that too. Knowing that and understanding that, it might be more challenging to qualify with a high debt to income ratio because of all of that additional cost added to the loan product. It's important to understand that with an FHA loan, they never get rid of the PMI unless you refinance the loan and bring it into an 80-20 loan product, at which point then the value of the home will have increased. You will have paid your loan down to a certain point. Remember, you have that silent second you have to count in there to see if you qualify for an 80-20 before you do that refinance. But that is the only way you're going to get rid of that private mortgage insurance. Now the PMI is something that you can't get away from on a low down payment loan program. So it's something that you're going to see whether you're using a down payment assistance program or not. So just know that it's an insurance for the lender, because the risk is higher when the home purchaser is not putting as much down, so there's a higher risk. If you'd like to learn more about a down payment assistance program, one, I'm going to link the CHAFA link down below. It's a Colorado, obviously, program. However, if you're watching this from another state, most states have a variety of different down payment assistance programs, and you could certainly reach out to a lender in your area that may work with them and be able to give you more information. And a great realtor in your area will also help you connect to lenders that use these programs. But it's a wonderful way to get your foot in the door and your first step to home ownership. I used it, my daughter used it, and it helped me get a leg up. So it does have its pros. If you'd like to learn more about how to calculate your debt to income ratio, because that term maybe was new to you, then check out this video next. Thanks so much for watching. Like and subscribe and share it with a friend, and I'll see you on the next video.